Hi, welcome to today's episode. My name is Peter, I'm a financial analyst, and today we'll be talking about one of the currently most popular investment opportunities on the stock market, which is NVIDIA. This is a part of a longer series where we will look at currently 5 most often bought stocks from the retail investors, so from small investors, sometimes called dump money, although dump money is not always dump and smart money is not always smart. But those are the most popular picks and the picks that people most often buy. And today we'll be looking at the fundamental analysis of NVIDIA. So we'll look at the operational activity, at the financial reports, growth, profitability, debt, and other metrics that are important to this company. First, let's talk a little bit about the operational activity of this company. So NVIDIA, the main thing that they do is they produce GPUs. Those are processing units. Basically, they do some like logical operations inside the computer. Simplifying it, when your computer does some operation, calculates something or shows you something, they use a GPU to do that. And NVIDIA had a huge boost in revenues and earnings because those GPUs are probably one of the best, if not the best GPUs. They're the best GPUs in the world right now. And also because those GPUs can be used for AI. So they're not only producing those AI GPUs, but they also have a software platform that can be used to develop and train AI models. They're also expanding their data center networks. So basically, data centers, those are like many computers connected all together working as one. So for instance, if you are talking to a certain AI, you are not talking to like one processor, one GPU at a time. There are many multiple GPUs that can be connected together, and then they have this huge power behind them. And let's go to the financial analysis. So in here we'll be looking at first the profitability of NVIDIA, because this is just amazing and huge profitability. Their gross margin is currently at 75. So this is a huge gross margin. And that means that after the costs of creating a product, 75% of the revenues are converted into gross profits. If you look at net margin, so this is like in reality how much, after paying taxes and other expenses, how much they are left with clean profits, clean cash after the sale. So if they sell something for $100, they will earn net earnings on that $100. That would be $55. So 55% net margin. This is a huge margin. The median of the last 10 years is around 36. So currently we are a little bit above the median. As you can see, the margins, they are steadily growing. At least here, the gross margin, it's been growing since 2004. And there was a spike in recent years. So seeing that the company, as it grows, can get more and more profitable is a very good sign. But if we look at return on assets, so how much money they are generating compared to their book value, so compared to their like machines and patents and programs that they own, and how much that book value can generate in terms of profits, we can see that this number is also huge, currently sitting around 60%. So this is much higher than any average for the US stock market. But we can also see that this number isn't very stable. It's been growing steadily at around 14% since 2010. So this is data for the last 15 years. But we can see that those margins, return on assets, they can vary a lot. So for instance, in 2018, we can see that the gross margin was at 40, but then in 2019, it dropped below 20. So that's a nearly 50% drop there. So what we can see right now is, right, NVIDIA has those huge margins here in 2014, but we can see that those margins may not last into the future. So this is something important, that, okay, this company is doing great right now, but are we sure that they will benefit from this AI revolution so much that they will be able to keep their margins high in the long term? So this is also very important. Do we believe that the AI will be like the next revolution, or maybe we are in some sort of a bubble and hype that might not last very long? This is a very important question that we need to ask ourselves. And if we look at price to earnings ratio, so currently the price to earnings ratio is around 50, 60. I think it's 57. I don't remember exactly. Yeah, it's this number right here, 57. So in 2015, during a crash that was connected to Trump and his tariffs, we could buy this NVIDIA at a much lower price, and then the PE was 32 or 33. So right now we are not buying at such a low valuation, but we are buying at 57. So that means if the company's earnings don't grow, it will take us 57 years to get to double our money. We'll look at it soon in more detail. I will show you how much this company earns per share. So if you own one share, how much earnings is this share generating each year? But as we can see, NVIDIA wasn't always trading at such a huge PE ratios. Since 2019, the COVID crash, the PE ratios grew a lot, but before that, this company was trading even in the range of 20, 25. So the current PE ratio isn't as high as it was, for instance, here in 2021, around 100, or during this massive spike here, all the way to 250. So it is below the median of 70, but still this number is huge. This is a huge PE ratio, but this is because this company is also growing very rapidly and has a way of investing their capital and getting a lot of money back from those investments because of those super high margins. And as we look at the price to book value ratio, we can see that currently for every $1 in book value, so this is all the like machines they have, all of the factories, all of the programs they own, etc. For each $1 of their, let's say they bought a factory for 1 billion, we'll need to pay 50 billion for that factory. So if the book value of this company is 1x, then we will be paying 50 times more. But this is also because this book value is generating so much profits that that's why we are paying so much for this book value. Because it all comes to the earnings and the growth of the earnings, because that's the company's ability to generate profits. So for instance, if we see those margins being at 70, 75%, this is why we have such a huge price to book value ratios. But if those margins were lower, let's say the margins was 3%, then the book value ratio can be even below 1. So it can be even 100 times smaller than this of NVIDIA. But that's because NVIDIA has this amazing power to generate earnings and also huge growth. So right now, we can see that this company was growing very rapidly. The average revenue growth for the past 10 years is 45%. But if you look on the 5-year and 1 year, you can see past 5 years, that's around 60% growth per year. And last year, the revenue grew about 90%. So this growth rate sped up in recent times. So that's why it all comes back to the thing, do we believe that this company can keep growing at such a high rate into the future? And it's very difficult for a company to keep growing at those growth rates of 60% or 90%. This can be very, very difficult, as sooner or later different companies might catch up to NVIDIA. I know it's very difficult. This is a very specialized technical field and it can be very difficult to catch up to this company. But if they do, this can lead to slowdown of this growth and slower growth with those high PE ratios and book to value, price to book value ratios that can lead to a stock price decline. So in here we are basing our investment a lot on the good predictions of the future for the company, and if those good predictions for the future won't happen, then investors can be in a lot of trouble. Let me check if the recording is going on. Yeah, everything is good. All right. Then let's look at the revenues per share. This is a quarterly chart. So you can see that the revenues skyrocketed in last 2 years. So this is also important to take into considerations. Are those amazing growth ratios going to continue, or is this sustainable? Can any company grow like 80% per year? Is this doable, or is this only a short-term revenue spike because maybe there is a lack of semiconductors, lack of GPUs in the world, and maybe if other companies catch up, because there will be a lot of different companies that will be trying to get into this sector because this sector is highly profitable. But the thing that is defending NVIDIA is how difficult this industry is. So it's not like, I don't know, baking bread or making pasta that everybody basically can start a company. This is a highly specialized field, and it might be difficult for new investors and new businesses to emerge and compete. And if you look at earnings per share, this is annual chart. We can see that currently per share, this company earns $3. So if we buy one share, then this share will in reality make $3 per year. So it's not a lot compared to the current stock price. And this is also a chart that some people might think, oh, this is amazing. Those are analyst ratings, and in here 66 brokerage firms are giving their opinion on the future of NVIDIA. And if you can see, nearly everybody is going to recommend a buy for NVIDIA, or that it will outperform the market. And some people, a small minority, are saying that it will be neutral, so this the hold, or only one company says that it will underperform. So everybody is very optimistic, which can be actually a negative sign, because if everybody is buying, that will drive price of this stock higher and higher, and at some point it will be overpriced. So they are very optimistic about the future. They see, oh, in the last 5 years the revenue grew 50-60%, so they might be thinking that this growth continues into the future, but the future is unknown, and we cannot say, oh, this company in last year grew so much, so probably in the future it will also grow so much. To really make this forecast, this outlook, we really need to understand this company in detail and this field in detail. And those brokerage firms, they analyze all of the different sectors, etc. So they don't understand such a difficult sector as semiconductors to probably forecast how in reality will the future earning growth look like. And coming to debt, so it's also important to see if this company doesn't have a lot of debt, because then they can go bankrupt. But in here we can see the cash to debt ratio of 4. This is huge. That means they have 4 times more money in the bank, cash in the bank, than debt. So there is basically no way that this company will go bankrupt. And that's of course because this company is making a lot of money. So there is no way they will go bankrupt because they don't have this much debt. And now for comparative comparison, in here we have the 3-year revenue growth rate. And we can see that NVIDIA here is growing at 75%, way above all of the other companies. So for instance, we have the AMD here on the red. You can see they're growing much slower than this company. So they are fast grower, but as you already know, will this amazing growth continue into the future? That isn't as certain. And if you like dividends, of course, you need to remember that dividends are taxed 2 times. So first, the company earns the money and pays tax on it. Then they send you the dividend and you pay tax on that dividend again. So dividends aren't really that good. If the company can invest the money or do something else, maybe repurchase stock, that would be, in my opinion at least, way more beneficial because then you don't have this double taxation of the money. But if you are a dividend investor, if you like dividend, NVIDIA isn't for you because they are paying around 0% in dividends. So they're paying basically no dividend at all. And yeah, if you look at the net income and revenue, so the blue and red, blue, that's the revenue, and green, that's the net income, we can see that it's skyrocketed in last 2 years. So before that, especially the net income was much smaller. So we need to be careful because this might be something that doesn't continue into the future, but of course this is very difficult to tell. And now let's look at the operating revenue by geographic region. So we can see that the majority of its sales is in the United States, around 47%, but there is also a lot in Taiwan, 16%, and 13% in China. And this can be problematic due to Trump tariffs. If there is a tariff war with different countries, especially with China, some of the revenues of NVIDIA can drop significantly in those 2 regions, especially China. And this chart here shows insider trades. So if insiders, people who work for NVIDIA, work at this company, if they are buying or selling the stock. And here we can see the chart for last 10 years and it's all red, meaning that the insiders, the people who work at this company, are only selling their stock basically. So we can see here that the president, CEO, I don't know how to pronounce his name, Sun Huang, he's selling, and other important directors, CFOs, etc. they're also selling. But what is important to look at that is optimistic for NVIDIA investors is, okay, he's selling, but he's not selling a lot, because look, he sold in here in August of 2025. He sold around 200,000 shares, but he owns 856 millions of them. So this is not even 1%. So right, he's selling, but he's selling a super small amount. And if we look at Guru trades, so those are the trades of the best investors worldwide, we can see that during the recent years, those are the last 3 years, the opinions of super investors were mixed. Some of them were buying, some of them were selling, especially here and here we can see that more of them were selling NVIDIA. So on average, a little bit more super investors are selling than buying. So this is also another sign to be cautious about this investment, at least if you want to follow other investors. Right, and next let's look at the cash flow statements, so where the money is going inside of the company. So first, the operational activity. What I like to see is a lot of money from the continuing operations, so like the basic operations of the business. But as you can see, this number grew a lot in the last 2 years. Before it was only 3, 4, 10, 4, and then to 30 and 70. So this is a huge spike that happened in recent years. And is this going to continue into the future? I don't know, but people look at it and they get super optimistic, and this is scary for me. This can be a possible trap. So let's look at the investments. So we can see that this company generated in 2025 at least 72 in I think those are in billions. So 72 are generated from the continuing operations. In the end, the cash flow from operations, so summing all of this up, is at 64, and our investments for this period is 20. So what they are doing with their money, they're purchasing some investments, also selling some investments. So they bought 18 of investments, and they also bought some business and purchased some plant, property, and equipment. So yeah, this is positive. We can see that around of 1/3 of their cash flows from operations are being reinvested, and that's good. We want to see this number as high as possible because those investments for NVIDIA, they are highly profitable. So we want them to invest as much money as possible, but of course not always do they have good ways to invest that money. And cash flow from financing, what we can see, -42. So this is, sometimes it's good, sometimes it's bad. It depends where this money is going. So we can see they're repurchasing their stocks. So we saw earlier that the insiders were selling the stock, but the company itself is buying, and it's buying a lot of its own stock, at least for the year 2025. And before, in 24 and 23, they were also buying, but not as aggressively as right now. So we can see that this company believes that these shares maybe are undervalued, or maybe they just don't have any better way of investing their money, and they don't just want to be sitting on cash. So they think, okay, buying our own stock is better. And this is a good sign for investors, because if they repurchase their stocks, and you are a shareholder, that means some of the stocks go from the market into the company, and you are basically a bigger shareholder. It can be easily understood. Let's say the company has only 100 shares and you own 1 share. But this company, so you own 1% of the company, right? But if the company buys back 50 of its shares, and on the market there are only 50 shares left, and you own 1 of those shares, but right now it's 2%. So you didn't buy any shares, but your ownership of the company grew from 1% to 2%, so it doubled because they bought back their shares. So it's really good that they are doing this. And they are not paying this much of dividend, which in my opinion is much better to see repurchase of stock rather than dividends, because dividends are double taxed. So also a great cash flow from financing. And right now let's look at the correlation between revenues and price to book value. So we can see that the revenues of the company are growing at the same speed as the price of the stock. The book value is growing a little bit slower than the revenues, but that's fine. They're becoming more and more profitable. There is a lot of demand for their GPUs, so that's why probably their revenues and earnings are growing faster than the book value. And if you look at the price to earnings ratio, we can see that the earnings were growing at the same speed as the price. Then there was this huge disproportion here during that small crash on the US stock market connected to the tariffs. But right now the price is close to the earnings growth. And that is similar if we look at the operating cash flow. All right, so that's all. That's all for NVIDIA for today. In the next episode, we'll be focusing on Apple stock. So yeah, in the all, summing up, NVIDIA is a great company, but there is a huge optimism among investors who are pushing the price higher and higher. It might be, it, well, in hindsight, we know that it would be a good opportunity to buy here during the tariff scare, but right now the price is close to the revenue, so there is no huge disproportion like this. There is no like anomaly of that the revenues are much higher than the price growth. It's similar, so there isn't like a huge anomaly or disproportion be that the earnings or revenues are growing quicker than the price. Sadly, the price of the stock is also growing quickly, but this is a great field to be in, highly profitable. So this company has a lot of place to grow and a lot of capital to invest. They're also repurchasing their stock. On the other hand, we need to be careful that those higher margins and high growth that we saw in the last few years might not continue into the future. And also the hype connected to this company, of course, it is understandable that people like to buy it because it's a great company, but we need to be careful because maybe a lot of buyers will lead to overinflation of the price, and the price might escape the real value of the business. So I would say that this company is fairly priced. We can see that the price follows the revenues and follows the earnings of this company. However, the future is uncertain, and currently it seems like market is pricing in that this huge growth will continue into the future, and the future is uncertain. If that doesn't happen, if those super high growth predictions don't happen, and there is a possibility of that not happening because those growth, like 70% growth, 60% growth per year, I don't think there is any company, even NVIDIA, that can do it over the next 5-10 years to keep this growth. So that can lead to price drop, or at least slower growth of the price of this stock in the future. So all in all, this is one of the leading companies in the world working in a sector that has huge demand, but it is also one of the hottest stocks right now. So a lot of people are watching, a lot of people are buying, and that can drive the price higher. But if you believe in the AI revolution, if you think this is something that will change the world, this company seems to be fairly priced. But of course, do your own due diligence, and remember that this is a very difficult sector to understand. Sometimes it can make it difficult to understand what is going on in the company, and especially difficult to understand what will happen in the future. Okay. Thank you for listening. I hope this helped you. Yeah, have a great day. Bye bye.